Friends, and key editorial from the Businessline discusses the discussion paper brought out by Securities Exchange Board of India on unregulated fintech platforms on bonds market. The title of the editorial is Booster Bonds, Bonds Booster. Fintech companies, that is financial technical companies, are those companies those use technical platforms and other related technologies to deal with the financial services. They are doing the stock market intermediary services also, that is the trading in securities, the issuance, facilitating the issuance of securities like the bonds and the debt securities. An example of fintech could be Zerodha, which is dealing with the stock market. There are many fintech companies in India like Paytm. However, for the stock market, Zerodha Securities is the apt example. So these fintech companies are dealing with the stock market securities, even the unregistered securities like the bonds, which are offered to the investors through the online technical platform. So the name fintech. These fintech companies are mostly dealing with the unregistered, that is the unlisted securities, that is private placement of the securities of the bonds, that is debt securities. Private placement is the case in which the securities do not register or list in the stock exchanges. However, they privately place their the companies privately place their debt securities or bonds to a few selected persons who will invest on those bonds. 98% of the securities, the debt securities traded in the stock exchange are privately placed. Hence, the fintech companies are very attractive because they make the retail investors, that is non-institutional investors, to trade, to place their investment in securities. Recently, during the COVID period, for the last 2 years, the fintech companies have increased manifold. So these people are facilitating the unlisted, that is not listed in stock exchange, securities like bonds through private placement. Mostly the private placement will be chased by institutional investors. The institutional investors are like LIC, the Pension Regulatory Authority funds. These are some institutional investors investing in bonds and securities in the stock exchange. The way in which the non-institutional investors like general public can invest in this privately placed debt securities is the mechanism of fintech companies. Now the Securities Exchange Board of India has come out with a discussion paper on how to regulate these fintech companies which are operating the public investment of debt securities in the privately placed securities, debt securities in the companies. The discussion paper states that the common standard procedures followed by all the market intermediaries should be followed by the fintech companies. And the stock exchange, the most of the transactions should be routed through the stock exchange and the clearing corporation. The SEBI wants, SEBI, which is the regulator of stock exchanges and the investor protection, wants the fintech companies should be integrated with the market intermediaries. Market intermediaries are the brokers for short. In simple terms, the brokers are the market intermediaries. So the fintech companies should be integrated with the market intermediaries, and the most of the transactions which are carried out by the online trading platforms of the fintech companies should route through the stock exchanges and the clearing corporations. Then the securities should be, the stock exchange wants that the securities should be routed through the stock exchanges. The SEBI wants the securities should be routed through the stock exchanges and the clearing corporations. What is missed in this aspect is that the stock exchange, the Securities Exchange Board of India requires the fintech companies to regulate only the listed securities. However, the unlisted securities are also very much popular with the fintech companies. Hence, the unlisted securities will cross through the fintech companies and reach the companies through as investment. However, as the discussion paper does not discuss on this aspect, the regulation of these securities will not be possible. The SEBI discussion paper also wants a redressal mechanism to be opened for the investors, because the fintech companies' investment by the public do not have any redressal mechanism if something goes wrong. So a redressal mechanism will be addressed through the SEBI discussion paper on unregulated fintech companies. What is again missed out is that in the SEBI discussion paper, the SEBI discussion paper should focus on the intermediaries making the background information on the securities in their websites and categorizing the securities on the basis of market risks. This information should have been given in the discussion paper, but it's not given. And the next one is that most of the securities, the debt securities and bonds are requires a very huge investment. That is, the investment level is set very high. This is being exploited by the fintech companies which make small chunks of investments, which is very much convenient for the public. However, the discussion paper should have made the level of investments smaller so that the public would have been attracted and the regulation of the fintech companies would have been very much easier. Hence, hope that these changes will also be brought in by the Securities Exchange Board of India in regulation of fintech companies. The regulation of fintech companies is necessary because the public investment is involved, and if anything goes wrong with the investment in this fintech company through the fintech companies, there is no redressal mechanism like the way in which the listed shares and securities investment is enjoying now. Thank you.